We've spent the last couple hours talking about pattern recognition. What we're going to cover next are rules and guidelines, why we pay attention to them, and then we'll wrap up with wave personalities. Right now we're on page 250, and first we're going to talk about rules. Let me mention first what we consider to be a definition. Corrections are never five-wave structures, so that's something to keep in mind. But as far as rules are concerned, the third wave among waves 1, 3, and 5 can never be the shortest. Wave 4 cannot overlap the price territory of wave 1. And wave 2 cannot retrace more than 100% of wave 1. Now, let me just elaborate a bit more on wave 4 not overlapping wave 1. The rule should be stated: the end of wave 4 cannot overlap the orthodox end of wave 1. But it is a very strong guideline that states that no portion of wave 4 should enter the price territory of either waves 1 or 2. Let me draw you an example. Suppose you've got a 1 and an irregular wave 2. You would be strongly advised not to label this in the following manner: this peak of 3, this decline a wave 4, because it comes down and overlaps the B wave within the wave 2 correction. Maybe this is an ABC up, and this is not turning into an impulse wave at all, or possibly it's a series of 1s and 2s. 1, 2, 1 of 3, 2 of 3. Either of those would be better counted than counting this as a wave 4 overlapping the price territory of either waves 1 or 2. I think you've seen this chart before. Let's take a look at it. Let's take a look at the lower picture first. Here's an example of incorrect counting. In this picture, wave 4 overlaps wave 1. That's not allowed. The better count, which would keep you in line with what the market was telling you and keep you from being unprepared, is that what you're doing is subdividing a third wave, and that the better count is 1, 2, 1, 2, 3. Another rule is that the third wave can never be the shortest, and that's what the diagram at the top of this page shows. In this count, 1, 2, 3, 4, 5, wave 3 is shorter than waves 1 and 5. Doesn't have to be and, can be either or. Just can't be the shortest wave. And the best way to count this structure would be as an extending third wave, 1, 2, 1, 2, 3. We took a look at page 251 very briefly earlier. Let's take a look at it again, because the only rule that we really applied that allowed us to place a very tight stop in July of 1986 and catch this turn at the peak of a diagonal triangle was not allowing the third wave within a structure to be the shortest. Again, this is the stock market, late June, early July 1986. Let me show you some price points. The peak of wave 1 within the diagonal is 1894. These are hourly. The low of wave 2 is 1876.55. The peak at 3 is 1902.98. And the low of wave 4 is 1889.76. And what that means is that wave 1 was 32.77 points. Wave 3 was 26.43 points. What do we know absolutely positively if this is going to be counted as a wave 5? Since 1 is already longer than 3, 5 must be shorter. That means that if we add the length of 3, 26.43, to the bottom of 4, the market cannot exceed that price, or our count is wrong, and we need to get out of the way and reassess and see what else is going on. Now, as it happened, the market ran up to 1910. I think it may have even traded in 1911 or 12 the following morning, following the hotline and the interim report that went out saying that stocks should be sold. What followed was the biggest down day in market history in terms of points at that point in time. And look at the risk that you had on this position. The market's at 1910 roughly when you're putting the position on. All you needed to do was get above 1902.98 on an hourly basis for wave 5. That was the minimum requirement. But it would be nice if it's subdivided into 3 waves, since we are talking about a diagonal triangle, and it would be nice if it came up and poked through the upper trend line of the diagonal triangle, which is typical, also which it did. You've got the Dow trading at 1910. Your stop can be placed very comfortably at 1917. You've got 7 points risk. That's less than 0.4 of 1 percentage point risk. This is the type of situation where it is acceptable to buy out-of-the-money options. You've got a high confidence trade, and you've got a low-risk situation. So you can buy out of the monies, not every other week like we all want to do. I know it's a third. Now, rules allow us to count in the first place. Otherwise, all we have is a subjective system. They give us objectivity, and therefore the decisions that we make are based on deductive reasoning. They're rules, that's it, don't break them, period, end. Guidelines are helpful observations about the way the market usually acts to help you arrange the probabilities of the outcomes of what the market is going to do. We've already discussed some of the guidelines. Bob touched on them earlier. We're going to look at them in a little bit different light or a little bit deeper right now. The guideline can help you forecast your target. They can help you verify your wave count. The guideline of alternation can help keep you in or out of a big move in the market so that you don't get all chopped up, getting in and out all over the place. Looking for previous fourth wave support enables you to look for a turn, whereas a trend following method may say, oh, it's a breakdown, you better not do it here, or it's a breakout, you better get back in this market. It gives you a different perspective. Now, Bob mentioned the rule of equality. All I'm going to do is repeat that. In a 5-wave structure, if the third wave is the longest, waves 5 and 1 tend toward equality in terms of both price and time. Remember the example we looked at earlier, 1982-87 versus 1932-37. The first guideline that I'd like to look at is presented on page 252, and that's alternation. We have so much confidence in this guideline that I'm sure you've heard us refer to it at one point or another as the rule of alternation, but it is a guideline. Which refers to corrective patterns. Usually it's concerning waves 2 and 4, and it has been stated in the past as simple versus complex, as is shown on page 252. It is actually better stated as sharp versus sideways, because sometimes a flat correction isn't necessarily very complex, and a triple zigzag can be extremely complex. So what you need to do is make those changes on that page. The main difference between a sideways correction and a sharp correction is that in a sideways correction, the price action will either tie or exceed the extreme point of the previous impulse wave. Let me draw you a quick example. There's your previous impulse wave. A sharp correction, the action within a sharp correction will come nowhere near this extreme. In a sideways pattern, sideways correction, expect to see a new extreme within the pattern. all the sharp corrections are the zigzags. Simple zigzag, single, double, and triple. And this makes it very easy. Sideways corrections, everything else. Flat, irregular, double and triple three, triangles, triangles in combinations with flat. Those all qualify as sideways. What does alternation mean? Very simply stated, if wave 2 is sharp, expect wave 4 to be sideways. If wave 2 is sideways, expect wave 4 to be sharp. Now, a triangle can occur in wave 4 and satisfy alternation even if wave 2 is sideways, but it's less likely. In other words, triangles alternate with everything else. Let me just show you an example. We took a look at this chart earlier on, page 2.7. One of the important reasons that Bob stayed long in the letter during this entire advance from the bottom of primary wave 2 to the peak of primary wave 3 was the guideline of alternation. Let's take a look at these corrective patterns. Here's intermediate wave 2, 2 in parentheses, there's a new high in it. It's sideways. Minor wave 2 has a new high. It's sideways. Same thing with minute wave 2. If we come up here and label within the structure minute wave 3, accordingly, which is the best labeling for that structure, then minuet wave 2 are all sideways corrections. What does that say? Don't bother counting to 4. There's no alternation. What you're seeing is a series of developing 1s and 2s. The first place that you could really say that any alternation was satisfied was in this sharp correction that didn't take place until the Dow had already exceeded 1850, almost 800 points above this low. That's a good reason to pay attention to the guideline of alternation. Now, there are a couple other instances when we look at that. Let's take a look at page 253 as far as alternation is concerned. Adjacent 3s tend not to repeat. In other words, if wave A in a pattern is a flat, expect wave B to be something else, like a zigzag. An example of this is shown on page 254. This is a chart of July cotton a few years back. Wave A is a 335 and is a flat correction. Wave B is a zigzag. Now, why would you not label this chart as an ABC X, because this certainly would qualify as an X, it's a 3-wave rally, and then label this decline as a zigzag, as another ABC? And the answer to that is because this decline is best counted as a 5-wave structure. And therefore, this is the best labeling for this chart. Flat A, zigzag B, 5 waves down for a C wave. Let's take a look at page 255. Here's a chart of Feb pork bellies. This is page 255. Wave 2 is a zigzag. Wave 4 is an irregular. 2 is sharp. Expect 4 to be sideways. Also contained a new high. You might make a mental note. This chart is full of Fibonacci relationships if you want something to come back and look at later on. Now, another guideline concerns the depth of corrective waves, and Bob talked about this earlier. A typical point to look for support in a corrective pattern is the span of the previous fourth wave of one lesser degree. We talk about the span of the previous fourth wave of one lesser degree. That's what we mean. Let's take a look at page 256. This chart appeared in the Elliott Wave Theorist in May 1986. This was a projection chart. This is how much reliability we place on the guidelines. Here's an example using the previous fourth wave of one lesser degree. This was a projection for market action. Here was what actually took place over the coming months. This was not done in retrospect. This was a forecast. We know these guidelines work more often than not. Now let's go to page 257. The next guideline that we're going to talk about is channeling. Channeling is used to assist in determining normal wave targets and to provide clues to the possible development of trends. Elliott regarded channeling as a very important tool in establishing targets and segregating individual waves. The complete technique for channeling involves several steps and several revisions. Before you can even get started, it's best to wait until waves 1 through 3 are done on a larger scale. Now remember, within each 5-wave structure, this still applies. So you can apply channeling on a 5-minute basis. We'll talk about a little bit bigger picture right here. Until waves 1 through 3 are done, you've already got your other guidelines in your arsenal. You can already look at the previous fourth wave. You can already look at Fibonacci relationships that exist. You can already look at the internal wave count to help you assess the end of wave 2, for example. Wave 3 is nearly impossible to forecast. You would look at a minimum of equality to wave 1, since wave 3 is normally longer, but channeling is very helpful for waves 4 and 5. Begin at the end of wave 3 to help estimate the bottom of wave 4. What you do, this is the labeling of this structure, first is connect points 1 and 3. Come down to point 2 and draw a parallel line to the one that you drew connecting points 1 and 3. That line will provide support for wave 4. Additionally, like I said, you've got internal wave structure. You look for a corrective pattern down here. You've got Fibonacci relationships. You've got your previous wave 4. So you're not dealing with this in a vacuum. Let's take a look at page 258. This is also a chart that appeared in the Elliott Wave Theorist. And you'll notice this strange dashed line in the middle of nowhere. But since you're aware of Elliott, you realize quickly that it's not in the middle of nowhere. What it really is a projection for where wave 4 should find support. Because what we've done is taken the peaks of wave 1 and 3 and connect that line. And then draw a parallel line to that line off of wave 2. It does not matter that it cuts through that price action. We'll take a look at what happened in just a moment. Now, traditional trend line drawing would not have you draw that line. You would draw probably this one, which is certainly a valid trend line. Of course, the rest of the civilized world will be drawing it. And then you've also got this line, which is also certainly valid. Unfortunately, what that tells you to do is it tells you it's late as far as telling you to sell it at this point here, and the best projection it gives you for the next pullback is, oh well, somewhere around 1450, 1500 we'll look to buy them. And you may miss a move here. Again, Elliott doesn't get every turn, but it does keep you more often than not from selling bottoms and buying tops. Page 259 is what took place afterwards. And there's that dashed trend line in the middle of nowhere, and that's where the market stopped. Now again, you also had Fibonacci calculations, you also had alternation, as we just discussed. Okay, I think I'd like to go to page 261. We'll come back to page 260. The final channel that Elliott suggested that we draw to obtain a measurement for wave 5 is the channel which is obtained by connecting points 2 and 4 and then drawing a parallel line through wave 3. Now, quite often this will be the same line that connected points 1 and 3, but it does not have to be. Now, additionally, for finding wave 5, we've got Fibonacci relationships. Wave 5 relative to 1 as a multiple, wave 5 relative to the net travel of waves 1 through 3, and also the implications with regard to extensions. If waves 1 and 3 are not extended, expect wave 5 to be extended, and so forth. But let's take a look at a couple of real-time examples as to how accurate this guideline is. This is a chart of the Dow Jones Industrial Average, 1932 through 1937 bull market. Now, this, remember, when you draw this channel, when you've drawn this channel, all you've seen of the price action is that. And your upper line is, and that this price action right now you're around 90, and the peak has been about 110 in this market. And that channel line comes in up in the ozone around Dow 200. And there aren't too many other methods which would suggest that the market was going to have that substantial a rally. But your proper channeling techniques, as suggested by Elliott, do. Additionally, wave 1 and wave 3 are not extended. So you'd expect wave 5 to be extended. And there's another reason to look for a more substantial rally there. The market didn't just come up here and then continue further. This was the peak, and the market then crashed to 100 later in 1937. Let's take a look at page 263. This is a chart of the CRB index. Again, what Elliott said is once waves, you've got 1, 2, 3, and 4 complete, let's look at this for an estimate for wave 5. Draw the line through points 2 and 4, draw a parallel line to that through point 3. And there's your peak way up there for the CRB index. Well, it didn't matter that it was way up there because that's where the CRB index came to and peaked and subsequently dropped down to roughly 196 in 1986, in the summer of 86. And 196, just out of coincidence, I'm sure it's nothing more than that, is right here in the span of the previous fourth wave. That would be the first place to look for any decent support. Whether that correction is all over or not, you don't know. Now, there's one exception to this channeling technique, and that's illustrated on page 264. In those cases where wave 3 is almost vertical and wave 4 is sideways, it is better to draw additionally a parallel line parallel to the line through points 2 and 4. Additionally, draw one through the peak at wave 1 to estimate a peak for wave 5, as is shown here, this dashed line. You will find in many cases that the point at which wave 3 cuts that channel line is the point of recognition, the point at which extraordinary acceleration occurred. Personally, I draw both lines most of the time, unless 3 is short and stubby, because it's just one extra tool to have. Let's take a look at page 264A, because here's an example of both. First, let's take a look at intermediate wave 3, which is what we've been talking about. Points you're here on the chart. This much of the pattern is complete. Elliott said take points 2 and 4, connect them with a line, draw a parallel line to that through point 3 to estimate a peak for wave 5. The market did peak in this area and had its largest correction for this entire period after that. Elliott also suggested that when wave 3 is vertical and wave 4 is sideways, and I think this certainly qualifies as sideways relative to this sharp wave 2, also draw a parallel line to the line through points 2 and 4 off of point 1 to estimate the peak for wave 5. And there you have it. Now let's move ahead to page 265. Okay, Elliott recognized that in any bull market, volume, which is the next guideline we're talking about, tended to expand and contract with the trend. He also noted that if the volume in wave 5 was greater than the volume in wave 3, then you should expect an extension in waves of intermediate degree or lower. Because typically, as Bob mentioned, wave 5 volume spikes, or wave 5 volume, is almost always less than the volume in wave 3. This helps confirm your wave count. And what I'm talking about is as follows. You've got a structure you want to count as a 5-wave structure, and what you're seeing on your volume scale looks like this. That volume pertains to wave 3, but then what you want to count as wave 5 has volume like this, for example. What you should be looking for is at least an extension in wave 5 and perhaps a better labeling of the entire structure would be that you are getting an extension within wave 3. Now, volume in corrective patterns will either contract, as it usually does in triangles or in combinations. Usually you see a clear dry up of volume all the way along, or it climaxes. And if it's going to do that, that usually occurs in a simple pattern, like a zigzag, and it's usually wave A or wave 3 of C. Now we use the peak volume reading on an hourly basis as our reference. On page 265 puts this all together. The question here is, does it make sense when we're labeling this last rally here to label it as a 5? Or should we be looking for some type of an extended rally in this pattern? Let's look at our guidelines and let's see what's satisfied and what argues for which case. First of all, the internal wave count is clean, 5, 3, 5, 3, 5. Now secondly, and again we want to change this, wave 2 is counted as a double zigzag. That's sharp. Wave 4 is obviously a sideways correction. It also contains a new price high, at least one new price high in the pattern. We just talked about volume. Here was peak volume in the 3rd wave. This is peak volume in the 5th wave, which is in what we want to count as the 5th wave, which is lower, and therefore supports that conclusion, that this is a 5th. Now, what about this volume that occurs right there? That occurred in the 4th wave. What Elliott stated in regard to volume was relative to wave 5 versus wave 3. What took place in the corrective wave in between does not fit into the equation. So it does not matter. Now additionally, basically this is a pretty messy pattern, and I'd be surprised pleasantly if it were to channel. But let's take a look at what Elliott said. Now we're talking about seeing this much of the pattern over to where wave 4 ended. Take a straight edge, connect points 2 and 4. Wave 3 is vertical, And wave 4 is certainly sideways, so let's draw a parallel line off of wave 1 first and see what happens. And that pretty much gave you a very good estimate for the peak of wave 5. You've got an internal wave count that says it's a fifth. You've got volume that says it's a fifth. It's acting like a fifth wave. You've satisfied the guideline of alternation. I should mention this corrective pattern came back into the area of the previous fourth wave of one lesser degree. Everything that Elliott teaches us says that it's best to count that as the end of a fifth, and that was the best way to count it. Let's take a look at page 266. At this point, right around here, in the stock market, this is the stock market back in 1928. This chart is from Richard Russell, of the Dow theory, I should mention. At this point, record volume occurred. Now, it didn't have to be record volume. All it had to be was larger than what occurred in wave 3, what you were counting at the time as a third wave. And what that implied was an extension of the fifth wave. Otherwise, you would have been counting 5 waves up and expect the move to be over. Now let's take a look at page 260. Because this volume that occurred here, the record volume, occurred right here. Is where that record volume occurred. And what that told you was to expect an extension in wave 5. And I am certain that at some point during this structure, you could have counted a completed 5-wave structure to the upside. But that guideline, since you kept seeing higher volume than what you would have been counting in a third wave, argued that you should stay in the market, which would have been quite profitable since the market ultimately went, you're talking when this occurred, the market was slightly above 200 and it moved to 381 before crashing in 1929-32. Let me also point out, Bob discussed very briefly semilog and arithmetic chart paper. The necessity for a semilog scale indicates a wave that is in the process of acceleration. And to stay on top of all developments, you should probably, if you can, plot larger moves, especially moves of any duration, on arithmetic and semilog paper, because there are times when a channel specifically will not show up on arithmetic paper, but it will show up on semi-logarithmic. That's it for guidelines. We talked about the rule of equality, alternation, previous fourth wave, channeling, volume. We've got our internal wave count now and pattern recognition, and we've got a pretty powerful principle that will enable us to trade the markets. Now, the final thing that we'll talk about is wave personalities, and that'll conclude today's session. Thank you very much. The final section that we'll cover this afternoon deals with wave personalities. We've already talked about pattern recognition, and we've covered rules and guidelines. And this final section will finish off the section on probabilities. Now, wave personality. Why does it even work? Why is it important? I think this sums it up. This is a quote from a book that's been written a few years ago. We find that whole communities suddenly fix their minds upon one subject and go mad in its pursuit. That millions of people become simultaneously impressed with one delusion and run after it. Men, it has well been said, think in herds. They go mad in herds, while they only recover their senses slowly and one by one. Now, that was written by Charles Mackay back in 1852. I'm sure some of you are familiar with it. That's from Extraordinary Popular Delusions and the Madness of Crowds. And I think better than anything, that sums up why the psychology is so relevant dealing with the market and why wave personality is an area that you should be interested in. The personality of each wave in an Elliott sequence is a critical part of the mass psychology that it displays. Personalities usually exist at every level of wave degree. Each wave implies a certain stage in the mass psychological progression of the market. So if your wave count is accurate, you can actually forecast the psychological and technical environment that you would expect to see. You can predict what type of action you should see in your oscillators and what type of action you should see in your sentiment measures. In turn, you can use the psychological and technical environment to lend weight to one wave count over another, or to help verify your wave count or correct an error that you might have made. Personality affects both sentiment and momentum areas. It's important for me to state that your indicators can help verify your opinion, but they should not formulate your opinion. That should be from the wave structure. Bob has already talked about personalities of certain waves, so what I'd like to do is just touch on some of the highlights of the others. Now, wave 1, a good place to start. Most wave 1s are part of a basing process. There's some new life to the market, but overall, there are no big momentum clues. They are sometimes heavily corrected by the wave 2, which follows. The big clue is the 5-wave structure in wave 1. Now, as far as momentum goes, sometimes wave 1 will show you the best overbought condition that you've seen in quite some time relative to the previous correction. We talked about the kickoff rally that occurred in 1982. I'll refer to that again in a moment. Wave 1s are much less emotional and less desperate and volatile than previous bear market rallies have been, probably because people are so wrung out by that time. But as a result, the public usually sells wave 1s heavily. This shows up in your sentiment figures, because what you will see in a wave 1 is that call premiums actually decline since the disbelief is so heavy at that time. Now, the rest of wave 1s are dynamic because they come from an extremely compressed or an extremely undervalued situation, or from a failure. We looked at a failure back in October of 1962. Wave 1 off that low is a good example. The example I just cited in 1982, coming from an extremely compressed or undervalued situation, as we had at the end of a 16-year bear market. But that's pretty much it for wave 1s. Wave 2, in a declining wave 2, pessimism rises. It is actually fashionable to be pessimistic. The larger trend is still considered down. Remember what Bob talked about when he described the wave 2 pullback from in 1937 through roughly 1942. Usually, wave 2s are sharp, but a long, drawn-out correction helps to develop that same kind of apathetic disgust with the market and everything associated with the market just as well. In other words, it doesn't matter how they wear you down, price or time, as long as they wear you down. Wave 2s also are typified by low volume at the end. Let's first take a look. This is page 269. This is the September low in 1985. At this point in the market, we'd been rallying for roughly 3/4 of a year off the low that occurred in early 1985 and off the primary wave 2 low, which occurred back in August of 1984. So the market had been up for quite some time now. That's the above chart. This middle chart is a 10-day moving average of a dollar-weighted call-put ratio. Now, what a call-put ratio measures, what option ratios measure in general, is the aggressiveness of those people who are playing with highly speculative vehicles. In this case, if the public at large is buying a tremendous amount of calls, reflecting a tremendous amount of bullish sentiment, you can expect that the market is not going to go substantially higher. Vice versa, if the public at large is buying a tremendous amount of puts, which would make this ratio come down here, the call-put ratio, reflecting a tremendous amount of bearish sentiment, you would expect that the market doesn't have that much more room on the downside. And that's what we see here. Now let me line up a few points for you. Intermediate wave 2 that occurred here on the chart, on the price of the Dow, is reflected with this point here. Minor wave 2 is reflected there. This minuet wave C is reflected at that low. And finally, minute wave 2 is over here. Now let's take a look at what has taken place here. At this low, for intermediate wave 2, which occurred at Dow 1180, the market was approximately 100 points higher than it was in the summer of 1984 when primary wave 2 bottomed at Dow 1084. And the call-put ratio was at the lowest level that it had been since that time. Now let's take a look at what happens. The market rallies and has a little retracement, comes back to Dow 1240, 60 Dow points higher than it was at intermediate wave 2, and yet the call-put ratio on a dollar-weighted basis is the lowest that it has been during this entire time. Watch how this continues, because this is typical personality within a wave 2, especially a wave 2 correcting a bull market pattern where the public disgust for the market continues to grow. At minuet wave C, right here, look where the call-put ratio is, almost off the chart. This set a record for the time that we had been keeping the chart, which at this point was over a couple of years, and yet the Dow is at 1300, almost 120 points above this point here. The market has trended higher. It just hasn't gone there as quickly as the public would like it to, and therefore they're disgusted with it. Now finally, that correction ended in September of 1985 at Dow 1290, a whopping 10 points lower than Dow 1300 back here, but it took a little bit longer and the public was pretty wrung out by this time, and the call-put ratio was in the basement on this chart. That, coupled with the bullish consensus number, as reported at the time by Peter Hacksteady, 23% bulls, presented a compelling sentiment picture for wanting to own stocks if all the other ingredients were in place. And that type of sentiment is typical at a turn, and it's very, very typical. That type of hatred of the market is very, very typical at the end of a wave 2. Now additionally, this lower chart also appeared in the letter. This is a 10-day moving average of the CBOE put-call ratio. On the bottom, the upper line is the Dow. Let's take a look at some of these numbers. Here's the August 82 bottom. This is at the end of a 16-year bear market, and the 10-day put-call ratio was peaked at 84. Now, that's a pretty impressive number. And the Dow, by the way, was at 777. Now, a couple years later, we made a bottom in August of 84, and the Dow bottomed at 1084, a little over 300 points higher. And yet the put-call ratio coming into this low on a 10-day basis was as high as 77%, which reflected a tremendous amount of animosity toward the market. And finally, at the low that we've seen here in September of 1985, the Dow is at 1290, 500 points off the August 82 low, and the 10-day CBOE went to a new high, reflecting even more pessimism. That's classic wave 2 action. That's wave 2 pessimism. This is wave 2 optimism, because it works both ways. Let's just focus, for example, we looked at put-call ratios. This top chart is also a chart of put-call ratios, but let's take a look at these two figures here. This lower chart is the Dow Jones Industrial Average on a daily basis. Some of you may recognize it. This was 2733. This is wave 1. This is wave 2. This is the picture we looked at earlier on the Dow when we looked at the Dow weekly. And what took place after this was that, down to wave 3. in October. But the point that I want to make here is in regard to this chart, which is a 10-day moving average of weighted futures premiums that we keep. Now this is the zero line here. The last time that futures premiums on a weighted basis, daily, had reached these levels was several years earlier in a B wave in 1984. We're going to take a look at that in a couple of minutes. The market had not made a new high. This was C of an irregular, right here at this point, and futures premiums were the highest that they had been in 3 years. That type of optimism is what you would expect to see in a wave 2, which is correcting a larger downtrend that is taking place. And of course, this was Dow 2645, or roughly. And that brings us to third waves. And Bob discussed these, so I'm just going to touch on them briefly. Third waves are almost always the longest and the strongest waves, especially in stocks. They're also display very good breadth. Again, all these are written down on the handout sheets. And they're most often extended. The reason is that the fundamentals improve during the third wave. Bob went over that in detail. The news feeds off the market or feeds on the market, and the market in turn feeds on the news. Volume picks up, people get more optimistic. One characteristic of a third wave is the power of the midpoint. It is the flash of recognition point. It's the point where the trend is fought up until then, and then it is accepted. In a bull market, it's where confidence returns. It's because the larger trend is considered up. Here's an example of a classic third of a third action. This is the point of recognition. That's where confidence ended as far as the bull market was concerned. That's the point of recognition in a third wave. At the center of a third wave, what you see is near vertical price action. You'll see continuation or breakaway gaps, a volume surge, extreme breadth, a late tape, expansion of premiums or discounts in some cases. All your momentum oscillators will confirm the move. Very few exceptions. And that extreme overbought or oversold that it leads to should be related to something along the lines of a rocket thrust. People say, oh, the market's overbought, it's a sale, it's overbought, it can't go any higher, or it's oversold, it can't go any lower. And that's incorrect to say it in that broad a fashion. Because if you view it as a rocket, the initial thrust that gets the rocket out of the atmosphere, that ends. But then the rocket still continues further. And the market should be viewed similarly as far as overbought or oversold conditions are concerned. Just because the market is overbought or oversold does not mean that a turn is imminent. Let me just show you this. This is page 265. We keep an hourly chart in dots at the office, among several other ways. And one reason for that is because the points stand out so clearly on the chart, especially if you're looking for action that might suggest that you're in a third wave. And I think it's very clear from this where the third wave took place. If I can line that back up again. Here's the third of the third as it's labeled on this chart right there. And you can see how nicely that stands out when you view it from that perspective. So that may be something you want to consider doing in your own work or with whatever markets you're following. That brings us to wave fours. Now wave fours will typically alternate with wave 2. As a result, they are usually sideways. In a sense, they're building a base for the fifth wave. They will typically find support or resistance at the previous fourth wave of one lesser degree. We've looked at several examples of that. As a matter of fact, Bob showed several earlier when he put up this chart where corrective action, here's 1942, train your eye to the left, there's a 4. Here's 1974, train your eye to the left, there's another wave 4. Corrective action, good place to look for it to end is in the area of a previous 4th wave. Wave 4s are typified by surprising disappointment. Also in wave 4, you'll begin a bear market in relatively weak stocks that were only held up initially as a result of the power behind wave 3. Now this news article is from late 1986 and occurred during, I think it may have been present just after or during primary wave 4 here. But I thought this was very typical of what people felt during a wave 4 as far as personality is concerned. And they're quoting someone who was a former Reagan administration Undersecretary of State. I'm afraid that after 6 years of things looking as if they were coming together, suddenly they are all coming apart for a variety of reasons. It could be a very rough 2 years ahead. We are seeing, as we did toward the end of the Carter administration, still got to get that dig in, right? Disarray, inability to cope with our problems, generalized fallout that is going to do damage. And this is the part that I love the best, says Fred Dutton, a former Secretary of the Cabinet during President Kennedy's Bay of Pigs debacle and currently a lobbyist whose clients include Saudi Arabia. Here this guy is back in a position of power with the administration, and where was he powerful before? Was back during the Bay of Pigs, which was primary wave 4 of cycle wave 3. And let's see if that'll work. There you go. Right here, Bay of Pigs. All right, and there's Fred Dutton, once again. Yeah, go figure. But anyhow, and that's what a wave 4 is like in a bull market, because it's a disappointment. If that's the case, then what should wave 4 be like if you're in a bear market and it's representing a rally phase? Well, this is taken from last November. November 11th, 1987 was the journal, and at the time we had completed this structure, and we were rallying in what turned out to be a triangle for intermediate wave 4. And let me just read you this article from the journal. Again, wave 4 is a surprising disappointment in one case. In the alternate case, what should it be? A pleasant surprise. Let's see. Investor anxiety over today's report about the U.S. merchandise trade deficit for September also dulled yesterday's market activity. They didn't know that they were going to change the accounting procedures this year. The memory of what happened last month when the August data were released is fresh in the minds of many investors and Wall Streeters. With expectations in such a tight range, many professionals, like this gentleman who I won't mention this year, are hoping that today's report will turn out to be, quote, a happy surprise. Any excuse to rally, any excuse to look for something good is typical psychology in a wave 4, that pleasant surprise that comes out in that case. Okay. And that brings us to wave 5s. The popular conception of wave 5s as explosive blow-offs is generally false. In commodity bull markets, it is true, as Bob described, but is almost never the case in stocks. Even when it is the case in stocks, fifth waves are technically weaker than third waves, especially in terms of breadth. Usually there is a lesser rate of change, there are momentum divergences. As far as the psychology is concerned, optimism continues to build and people continue to deny the problems that exist. One reason for the advanced decline statistics being so poor is that people were jumping from one hot stock to another. Speculation is often in evidence, quite often in evidence. In the 1920s, you had 10% margin. In the 1980s, coming from having maybe 7 put options and a couple dozen call options, you had options on several hundred stocks. You had futures. You had options on futures. You had strike prices, strike prices on every month. Remember when they used to be every 3 months? They used to be series. Now they're every month on options. And of course, that's because they're for investment purposes, not speculation. You've got a thriving financial news network. You've got people talking about, or at least you had people talking about up through 1987, the abolition of margin requirements, and you've still got new indexes being introduced. They're talking about introducing an S&P 250. This is all typical of a fifth wave. Now, in commodities, this is page 115, and we looked at this earlier. In a bear trend, the same observations hold true as they do for stocks. In other words, the third wave is the strongest. But in a bull trend, the fifth wave is often the longest and the strongest, as it is in this picture. Here's wave 4, here's wave 5. This is the cocoa chart that we took a look at earlier. And the reason is the difference in the basic human emotion that is operating, hope versus fear. We hope about the future. We hope things get better. I hope my stock goes up. Commodities are not driven by hope. All right, when we think about war, people drive up the price of gold. When we think about drought, people drive up the prices of grains, as they did this year, or the prices of grains are driven up. If there's a freeze, people buy orange juice, but they're not buying it out of hope, they're buying it out of fear. In a commodity market, what you see here is a parabolic advance which leads to a spike top. There is quite often no divergent warning signal. Elliott is one of the only useful tools in this case that can help you recognize a top. Other tools such as sentiment figures and open interest will certainly be helpful, but they won't pinpoint the top like Elliott can, and they can bankrupt you if you're early. If you're late, you've missed the entry, and that's it. Only an Elliott count can get you to short strength on the day of the top, or to buy weakness on the day of the bottom. Okay, now let's move to corrective waves, or the lettered waves anyhow.
A waves are often sharp and provide a deeper reaction than what occurred in the previous impulse wave.
There's an A wave in this cocoa chart. All right, some A waves are killers, especially in zigzags. The 1929 stock market crash was part of an A wave. A waves following extensions in commodity markets are usually crashes, leaving a spike on the chart. Right there, say hello to spike. That type of reversal. No matter what style the A wave takes, hopes remain alive. And those hopes are what are rekindled into that desperate bullishness that you see in B waves. Because the A wave is viewed as merely a correction of the ongoing bull market. The public surges to the buy side of the market, thinking that they are being presented with bargains as compared to recent history. It is evident in the sentiment figures, such as odd lots, option premiums, futures premiums, etc. On a momentum basis, an A wave will usually generate the deepest oversold condition that you've seen since the preceding uptrend began. And that can be a very important clue. Next are B waves. This is my favorite section of Elliott wave principle. In describing upside B waves, upside B waves are phonies. They're sucker plays, bull traps, a speculator's paradise, orgies of odd lotter mentality. Can't you see all those odd lotters out there? Often emotional, rarely technically strong, and doomed to retracement by the C wave that follows. B waves are usually zigzags. The next most common shape in a B wave is a triangle. Most importantly, B waves are never five-wave structures. Now, as we mentioned, the confidence rapidly returns. I think 1930 is an excellent example of that, B wave. We retraced 50%. When people talk about the 1929 crash, many people, for for a long time, nobody ever told you what happened 1930 to 1932, and that was the true devastation. That was when we lost 90% of our value as far as the stock market was concerned. I guess I should point out it was only devastating if you owned stocks at the time. Another classic example of B-wave personality occurred right here at the 1968 peak in stock market prices. This was the low-price stock craze. The value line index was at an all-time high. There were unheard of PE ratios. The mutual fund craze was in full force, and everyone was exhilarated about where the stock market was going to go. This peak occurred, we've been in a bull market from 1942 till 1966 at the orthodox peak right here. People felt that was going to continue. It didn't, and that was ultimately corrected. And so were all those of excesses in this C wave, which finally bottomed in 1970. Additionally, this B wave that took place in 1973 was accompanied by an institutional buying frenzy. This was when the Nifty 50 was as hot as it got, but prices then declined, almost cut in half, down into the lows in late 1974. Page 271. Chart of the Dow Jones Industrial Average hourly. And this action took place in 1984, actually roughly August of 1984. And this upper chart is a chart of the futures premiums that we talked about earlier. And what we saw here, this peak that occurred in October, slightly above 400,
and reflecting typical bullish sentiment at the top of a B wave,
was the highest level that we'd ever seen since we'd started keeping the oscillator, which was about 3 years earlier. And that level coincided with this peak right there, which was this peak right here. Now, what had taken place just prior to that time? Well, you had the August 84 explosion in the Dow. We had a couple of real sharp days coming off the bottom of primary wave 2. And what people were expecting at that time, as was indicated in the futures premiums, was a continuation of that acceleration to the upside. And that was not to be, at least not immediately. And that type of sentiment is typical of a B wave, and that's how it can show up. And that brings us to C waves. C waves are always 5-wave structures. By the way, this is page 247 that I've got up here for reference. C waves are often powerful because they are impulse waves. The main change in a C wave is psychological. The third of the C wave is where the point of recognition takes place in corrections. In a decline, that's where fear takes over. In an advance, that's where the investor commits his last marginable dollar. Well, let's take a look at some C waves. First, 1930 to 1932 we just talked about. 1969 to 1970 was a devastating C wave. Within this larger pattern, intermediate wave C from this peak in 1973 was typical C wave action. Now that's basically it. Remember, personality categories are suggestive. They are not inevitable. They are guidelines. They are not rules. But with the proper knowledge of the characteristics in each personality, the analyst has that much more confidence in order to verify your wave count. Now this chart will help illustrate why the average investor never makes money. And the reason for that, all we're looking at are points of recognition. Here's the third of a third. And the investor realizes the trend is up and turns bullish. Now there's a third of a C. And the investor realizes that the trend is down and turns bearish. And this goes on and on And he doesn't realize that the market is going higher again until there. And that looks like an unhealthy trade. And then he doesn't realize that it's going lower again until there. And this goes on and on and on. And on a bigger picture, here's the third of this structure, and here's the third of this structure, and so on and so forth. This is true on all degrees, which is what makes the whole process dynamic. Now, trading along these lines, you can lose your money in 10 years in the stock market, or you could lose it in 10 weeks in the options market. The choice is yours. Or you can use Elliott. Now, the best learning procedure, if you're trying to learn Elliott, is to keep an hourly chart and try to fit all the wiggles that you see into Elliott patterns without breaking any rules, adhering to guidelines, and keeping an open mind to the various possibilities. Elliott prepares us psychologically. It gives us a different perspective than anything else that is available, than any other approach. In The Sign of the Four, which was written by Sir Arthur Conan Doyle, Sherlock Holmes is speaking, and what he said was, when you have eliminated the impossible, whatever remains, however improbable, must be the truth. And that's how you should use Elliott. And in closing, I'd like to read this story that I obtained through an insurance claims manager. And I understand that this is true. I am writing in response to your request for additional information on my accident. I put poor planning as the cause of my accident. You said that I should explain more fully. I trust that the following details will be sufficient. I am a bricklayer. On the day of the accident, I was working alone on the roof of a new 6-story building. When I completed my work, I discovered that I had about 500 pounds of bricks left over. Rather than carry them down by hand, I decided to lower them in a barrel by using a pulley that was attached to the side of the building at the 6th floor. Securing the rope at ground level, I went up to the roof, swung the barrel out, and loaded the bricks into it. Then I went back to the ground and untied the rope, holding it tightly to ensure a slow descent of the 500 pounds of bricks. You will note in the accident reporting form that I weigh 165 pounds. Due to my surprise at being jerked off the ground so suddenly, I lost my presence of mind and forgot to let go of the rope. Needless to say, I proceeded at a rather rapid rate up the side of the building. In the vicinity of the 3rd floor, I met the barrel coming down. This explains the fractured skull and broken collarbone. I continued my rapid ascent until the fingers of my right hand were 2 knuckles deep into the pulley. Fortunately, I had regained my presence of mind and was able to hold tightly to the rope in spite of my pain. At the same time, however, the barrel of bricks hit the ground and the bottom broke out of the barrel. Without the weight of the bricks, the barrel now weighed approximately 50 pounds. I refer you again to my weight of 165 pounds. As you might imagine, I began a rapid descent down the side of the building. In the vicinity of the 3rd floor, I met the barrel coming up. This accounts for the 2 fractured ankles and the lacerations of my legs and lower body. The encounter with the barrel slowed me enough to lessen additional injuries. When I fell onto the pile of bricks on the ground, only 3 vertebrae were cracked. I'm sorry to report, however, that as I lay on the bricks, unable to stand, watching the empty barrel 6 stories above, I again lost my presence of mind and let go of the rope. This accounts for the lacerations and puncture wounds on my back. I hope this is satisfactory for your needs. If I can be of any further help, please do not hesitate to advise. And the moral here is, if you don't know when to hang on and when to let go, you're going to get hurt out there. The perspective that we get from Elliott answers those questions. Thank you very, very much for your time. I've enjoyed it. Thank you.